Hope everyone's doing well today. So I'm going to review the past few days. So here's Monday. We had a big gap down, and usually the first thing you should expect on a gap down is sideways to the moving average, and usually that can come in a few ways. Maybe you form some sort of wedge top, or you form a double top, or if you're selling off, usually you form a wedge bottom or double bottom. Really, what I think the most important thing to understand with the gap, especially one of that size, is that with the gap down, you're generally going to go sideways to the moving average most of the time. And when you think about it, price opened here. So the moving average hypothetically is, if 897 all the way to, 930. So it's like 40 something points away. So you have to ask yourself, are you really willing to sell 40 points below the moving average? Look at the close. Think about a daily chart. If yesterday's close, which would be Friday, March 3rd, if the close is up here, that means the day's range is from this close all the way to the open already. Therefore, high probability you're going to get a pullback, which is why everybody bought. They just buy at the market. I'm sure if we looked at a 1 minute chart, we'd see an early reversal and you would see traders buying. In fact, I'm actually going to do that just for fun. So let me just look at that real quick. So So here is the day. Yep, there you go. So just as I was telling you, it's so obvious. Traders just bought bar one on the 1 minute chart all the way up. So it's buy the close, bar two, bar three. Now, I wouldn't recommend that. Looking at 1 minute charts, I think people can do it, but you really need to be quick and understand the overall context. So the traders that are looking at a 1 minute chart during the open, they already realize it's a huge gap down. They're looking for a stop entry. So they're just trying to get in earlier, but they already realize the context. So again, I would not recommend that for most people. Anyways, big bar one, great risk, which is why it's great to be able to trade the SPY, especially now that people can trade the micro E-minis. I've heard that the volume on that is, I've looked at the chart and it's nearly identical. It is identical to the E-mini and the SPY. But anyways, it's buy above bar one, you're always in long, but stops far, and you have to think we may get a 50% pullback of the range. Obviously we didn't there, but we may with bar two. Bar two, okay bar, but it's significantly smaller, so you still have to wonder, now there's big risk. So you got to ask yourself, what are the odds if you buy the close at 2, stop down here? What are the odds you get up to here? I don't know if it's 60%. I think more likely we're going to go sideways. So not really a great buy the close bar. However, it's so strong, any reversal will be minor and traders will buy. Bad bar 3, probably buyers below, but stop down here. And, here, again, found buyers. Bulls buy the close, they buy more lower, they get out at a new high. Some traders will sell a new high, and you can, but kind of difficult when the moving average is this far away. So, and what I mean by that, they'll sell the high, they'll scale in more higher and use a wide stop, scalp out. But you got to be quick because, look what happens. It's, it's very quick trade. So anyways, quick trade. Traders will sell, scale in, scalp out. And traders will do the same thing here. They're going to sell more higher, scalp out. But the problem is the channel is very tight, so you have to be really careful. Sorry about that. You got to be careful doing that, especially when you get 3 consecutive bull bars up like that. Less traders are going to be selling at new highs. But again, bears are making money. So it's a sign that there's something wrong with the rally. One thing to point out, I know I'm talking from the bear's perspective. However, it is always in long, so bulls will buy. Bulls will buy, and no reason to get out here. Some will get out here just because I just wedge top, and you may test all the way down to here. So, there's not a lot of, you're probably not going to go much higher. So it does make sense to get out below. Aggressive bears will sell, betting on a sharp sell-off, but when they don't get it, it's smart to just get out because they expect a two-legged pullback. Right here, we have a wedge top, so you have to think we're trying to break above it, 50-50 chance. In general, you get a break above the wedge and a measured move. However, probably not going to happen because we're right next to the moving average, not a strong breakout. However, it is a surprise, so it's a strong enough breakout for at least a second leg, and it could be consecutive tops. Here's a wedge, 1, 2, 3, and then we form another top up here. So strong enough breakout for a second leg. Bulls will buy this low. Some traders will sell new highs. They've been selling all the way up, so it's a working strategy. Probably okay to sell this high, which clearly they did. Here, surprise bar. It's a big bear bar, but it's a surprise bar in a tight channel or tight bull channel or trading range. So the odds are you'll get a second leg down. So I would not buy above it. Here's your second leg. However, you're probably going to form a trading range. So there will be buyers somewhere below here and maybe at this low down here. I think it's a trading range, so I do think we'll get down here. Also, this low, I believe it's the bar 15 low. I can't remember, but it's a 945 low. Traders will buy it. Well, it was reasonable to sell it. It's a second entry short. So some traders, instead of selling, they may put a stop, somewhere up here, or they'll sell more up here, use a wide stop. So we very well may test back down here. Also, you have to be thinking about measured move projections. An obvious one is the measured move of bar 1. Another one is the measured move of bar 2, 1 and 2. Didn't reach. Another is the open and close of the open of bar 1, close of bar 2. We just touched it, so that was reasonable. Now again, strong enough surprise bar for a second leg, however in a trading range, so we may test the high of this bar before we get the second leg, which is what happened. We had the same thing happen today, where we had if I can think through this. Yeah, so obviously dominant bar, probably going to control the rest of the day and either go sideways or up for the rest of the day. And same thing here, surprise. Odds are we're going to go sideways to down for at least a couple legs, which we did 1, 2, 3 legs down. But right here, this was important. So we had a big surprise bar up, and it's a micro channel. It's a 1, 2, 3, 4 bar micro channel. Only one bar in the past 5, 6 bars that was a bare body. So the odds are you'll get a second leg up. However, the problem is it's forcing you to sell, forcing you to buy at a new high, and there may be sellers up there. And the difficult part is what traders don't know is, will there be a second leg up and then traders sell, or are we going to go have a deep pullback? So in hindsight, bears made money selling this close. But again, my whole point is strong enough surprise for a second leg. However, this was the surprise bar. We went below the surprise bar and got our second leg up, but the second leg just retested the close of the surprise bar. This sell-off, this bar in particular, is surprising. And you don't have to think of it this way. If you want, you can reserve surprise bars for things like this or this. I like to be a little more flexible and think a little bit more in depth, if you will. This is another surprise bar. This is strong enough that you probably will have a second leg. However, you may test all the way back up here before you get the second leg down. And in hindsight, here's our second leg. This is kind of a surprise, so may get a little more down. Arguably, there's a second leg. We had a breakout, pause, another second leg. But anyways, the whole point is when you have a tight channel and you get a surprise, that you may just go sideways for 2 legs, or go, you have a surprise, deep pullback, and more down. In the case of here, This is a bad stop because we may fall all the way below this stop, but hold and test up. So again, very tight channel. Surprise bar, traders may wait for one, 2 or 3 legs down, ultimately 3 legs, 1, 2, 3, but they were sideways. We tested the low down here, so mission accomplished, and probably going higher. Over here, it's reasonable, failed breakout below a trading range, call it whatever you want. We're not clearly always in short, we're still always in long. Maybe reasonable to buy. If you don't buy there, you buy anywhere. Buy below bars, buy above bars. It didn't become clear until here. You can make the argument this is exhaustion. We're many bars into a rally, more than 20 bars into a rally. However, we're mostly sideways and we're breaking above the range. Therefore, there's at least a 50-50 chance that this breakout may be successful. And then you get another bull bar. So surprise, odds are you're going to get a second leg. So you have bears that are trapped. And a surprise, if you think about it, a surprise bar, it does a few things. Al has coined a new term, I believe, called dominant bars and surprise bars. And they're the same thing. It's just a little bit more of a definition between them. This is a surprise because it traps traders. This traps traders. It's a low probability event. The easiest example is this right here. This will trap any bear that was short on the open. They're now trapped. They're going to sell out of longs. They're going to buy back losing shorts on any pullback. Bulls are trapped out. They're going to buy any pullback to get in. So you have bears that are trapped in the market. You have bulls that are trapped out. Both will buy a pullback. Here's the same thing. Bears didn't sell. They want to sell a pullback. Bulls who bought are trapped into a losing trade. They want to get out with a smaller loss, just as the bears want to get in a higher price. So you'll get a pullback. Breakout, surprise, you have bulls who did not buy the breakout. They're trapped. They want to get in for a second leg. You also have bears who sell this high and they're trapped. They're going to use any pullback to get out with as small loss as possible and maybe break even. Another bull bar, so even more surprise, probably going higher. We had a breakout, 2 follow-through bars. So that's good for the bulls. Buy the close, buy the close, buy the close. Here, you're getting a problem. It's a 1, 2, 3, 4, 5, 7 bar micro channel. Typically, when you get that, you end up getting a pullback. So it's becoming less, and it is buy the close, but it's becoming, at some point, traders are going to buy pullbacks rather than closes. So you can argue parabolic wedge, one way or another, but it's just parabolic. Here's top of the channel, we're going up, we're going up. This is unsustainable. So both the odds are the first reversal will fail, and maybe it's right here, bulls bought this low, scalped out, Probably going to have a pullback, however, probably going to go sideways. You can even make the argument, here's a surprise bar, but it's so small that, we could go down, pull back, and have another bar down. Maybe that's the second leg of a surprise. So it's really not worth considering. Traders expect a new high. They expect price to go up here, and they're going to sell. And look what happened. As soon as we went above this high right here, we sold off. So that's what traders are doing. Also, tight trading range. Hadn't touched the moving average many bars. There will be buyers down here. Probably a bad high one buy. We broke to the upside and went sideways for so many bars that we're probably going to break out and go sideways for a lot of bars. I would not buy above it because I think we're going to fall below the signal bar, which we did. And a lot of traders sold it. So 3 pushes up, you can call it a wedge, triangle, doesn't really matter. I think we're getting down here. And again, this may be a surprise bar, and you probably will get a second leg in the moving average, but you're probably going to form a trading range. You have to wonder about the traders who sold this high. What are they going to do? Are they going to sell more here? I don't know. But I think we're going to get somewhere in this region because a trader who sold this high or, maybe sold this high are going to try and get out break even. So surprise bar, but that follow through lowers the probability of a lot more down, probably just a little more down. And we may have to get a new high before we go down. Now also to point out, I didn't realize we're late in the day, so I kind of, I think anybody should just get out of shorts above that bar, even though we'll probably pull back. And there you go. We tried to pull back to 50%. So always in for the whole day. Never went always in short. Bulls will buy. They can get out below this bar. Aggressive bears can sell if they understand that it's possible wedge top and we may get a deep sell-off. However, a lot of those bears are going to be very quick to exit and they'll probably get out break even. So always in, bulls buy. They probably get out below here. They got to buy again above here, second entry buy. Some will buy here, but I don't think it's that great. It's a micro channel and it's pretty tight. Sorry for my voice. My throat gets dry when I do these. Bulls will buy again. Strong enough breakout for a second leg. You don't have to get out there, but some traders, definitely get out below here. And again, this is the problem. It's a trading range. This is trading range price action. It's not that clear. Bulls are buying below bars. Bears are selling above bars. So once you start to do this, I wouldn't swing trade. Bears get out here. Maybe they get out below this bar, but forcing you to sell at the bottom of the range. If they do get out, do they buy here? They can, but pretty much tight trading range. So I don't think it's worth it. And you're probably going to get, you may get a second leg down from here. If this was a surprise, odds favored a second leg. Maybe you get a second leg here because this is a little bit of a surprise. And we got that here. So bulls can start buying here or they can start buying up here, tight channel. Clearly became always in long again. We never went always in short here. So bulls will buy here and then they'll buy all the way up. And then we went sideways the rest of the day. Kind of a trending trading range. So bull trend sideways, breakout sideways. Only real difference is here. It's kind of interesting. We had a breakout here, very, very strong. However, and it trickled up more slowly, but the odds of a bear trend were really, really small. Here we broke out rather quickly with more bars, but we went sideways for longer. So depends on how you look at it. If you were willing to use the wide stop and take on the big risk, you were able to make more right here. Over here, you had to buy very quickly, and if you didn't, it went sideways. So again, next day, big gap down. Bar one closing on its high. It's an okay buy, but it's again not great. It's not significantly big, and traders wonder if this is a breakout from the break below this low. And a few things you got to think about. Here's the low of the day. Well, not really. There, I take that back. So it's an okay buy, but bar two is smaller. So you still may fall below this low. And the odds favored a second leg up though. And then you got a strong bear breakout. This is a surprise. This is a credible, what you have to understand is this is a credible buy. It's reasonable. The problem is that when you get a reasonable buy like this, the odds are you're going to get a small second leg up, and you don't get it. You just get a strong breakout below. This trapped traders who bought here, it trapped traders who bought this low. So the problem here is, okay, it's a surprise. Remember, surprise, dominant feature. This has trapped bears out of the market. You have bears wanting to sell. They didn't want to sell because of the gap down. They wanted to sell a pullback. Now they're being forced to sell even further away from the open on a gap down with the moving average up here. You have bulls who are long, trapped in the market. They want to use any bounce they can to get out, break even. Some bulls bought this low. It's reasonable to buy the low, and now they're trapped. So the odds are any pullback will be minor and you'll get a second leg. We have a doji, 3 bear bars, well, 3 non-bull bars, but it's not a strong buy. It's a doji, therefore probably sellers above somewhere, maybe back at the breakout point, maybe above this bar, maybe a little bit more. So bulls will not buy above it. Some may buy for a scalp. If you think about the logic, you could, and this is kind of more of a scalping mindset, but if you think about it, bulls are trapped. Bulls bought this low, and they're going to use something to try to get out with a smaller loss. So if you think about it like this, here's basically the low. Here's the close. Some bulls may buy this close or buy the close of the doji for, a 2-point scalp. But I wouldn't recommend that. I think it's kind of hard. You have to be very quick. The profit's pretty small. Someone's going to be much better off selling above. And there you go. So you had a lot of bulls. They tried to get out of break even. You can see they got trapped. We're forming a gap. And they just bailed out on this bar. So breakout, second leg, but strong enough you may get another second leg. Here, the bulls made money buying. We now have a wedge bottom, 3 pushes down, 1, 2, 3. So you can make the argument we'll get another leg up. However, the problem you have is that you have bulls who, this may be strong enough for a third leg. So 1, 2, 3, and we may fall and get a new low here. So didn't trigger, lowers the probability. Now we have another leg down. So 1, 2, 3, 3 pushes down. Here's an okay buy for at least a few legs up. Always in bears definitely get out. So always in, what do? It's hard. Some bears will sell this close and they'll hold short because this is a bad stop entry. Others will sell here, sell above for a few legs down. Most of, if not all, will get out above this bar and wait for a few legs sideways to up. It's kind of parabolic. It's unsustainable. You have bulls that are making money. They're probably, the reality is the bulls that, the bulls may still make money buying here. However, very tight channel. Bull, if they buy, they put their stop down here. 3 consecutive bull bars, a surprise. Odds are you'll get a second leg up. However, you have to be concerned. At any moment, we could form a double top. We tried to do that today. Over here, we tried to form a double top right here. So tight channel, kind of a wedge, broke out to the upside, but it could be a double top and you get a measure move down. They never look reasonable, but they're 40%. And over here, it just didn't work. So 3 pushes down and the bulls failed. Back to today. So kind of as I was saying, do like this. There we go. Reasonable, kind of a surprise. Probably will go a little bit higher, but double top. So you have to always wonder. Gap down, strong selling. We may get this. We may get that. 40% chance. So I would definitely get out below the bar. I don't know if I'd sell, but bulls definitely get out. Follow through. 3 consecutive bear bars, probably at least a second leg down. We have a wedge bottom, so now you have to be thinking we may get a break below the wedge bottom and a measure move down. Bad buy signal. Odds are, again, second leg. The bulls will buy down here. I don't know if I'd buy that low because 3 consecutive bear bars and you're in a bear trend. Therefore, a lot of bulls, if they bought the low, would probably just exit on this bar for take a few tick loss. So, bulls will buy, scalp out, but very tight. Dangerous to be buying. Big bear bar. But, surprise, odds are you'll get a second leg. We have a second leg, and you may get that. So at the end of the day, bulls made money. So we're forming a tight channel. Bulls are making money buying below bars. So probably going to go evolve into a trading range soon. Soon does not mean right now. Soon means at some point. So we could go all the way down here. We could keep trickling down. So dangerous buy. The smart bulls are doing a few things. Some bulls will buy here, scale in more lower, and get out. And look what happened. A lot of bulls are doing that. We're not even getting back up here. Other bulls will buy, scale in lower. They may buy 4 points below this low and scalp out because they're confident at some point soon, no matter, just as over here, we went a little bit lower, found buyers. Broke below the low, went a little bit lower, found buyers. They're confident we're going to find buyers, but they're using this to take profits. You also have bears. You also have bears who are selling. They don't want to sell a new low. They want to sell above new lows. Therefore, they're taking profits at new lows, and they're selling strong rallies. Strong rally, they sold. Strong rally, sold. Strong rally, sold. rally above a bar, sold. And right here, this is also kind of interesting. Again, bulls will buy, disappointed by this. They'll set limit orders to take profits. They'll buy because it's a wedge, and they're disappointed. And if they're quick, their entry may be 525. And if they're really quick, they may try and get out with the few ticks loss, which is exactly what happened here. You can also argue that this is it's just a retest. So if you have bulls you'll have bears who will sell the low of this bar at 95 even. They'll get filled at 475. Some bears, will, take profits at 275, 2 points lower, and which means price needs to go to 250. And of course, it went many, many points below, but at the end of the day, this went right back to their entry. So it actually stopped out break-even bulls. Bulls will break even bears. Bears sell here, sells off, they set their stop at break-even, they get stopped out. The smart bears will sell, they'll take part off at a new low, and they'll sell again right at their entry price here and do the same thing again. But anyways, it's a scalper's market. Bulls are buying. They know the risk reward is bad. So they're buying down here, taking profits, 50% pullback. And it's a double top. So bulls, just as the bulls wanted a double top here. So we have a high, a second high, break below. It never looks like you're going to reach it, but you often do, 40% of the time. So bears want the same thing again, double top, trying to get it, but trying to form, getting bad stop entries, bad bear stop entries, and we're kind of just trickling down. So bulls are starting to make money buying new lows. Again, odds favor a trading range, trying to form a bottom, maybe strong breakout for a few legs down. We have that. Breaking above the moving average, however, it's the first close above the moving average. Traders are going to sell it, but they may say this is strong enough for a second leg, I'll wait. Other bears will say, screw it, I'll just sell because we're at this high. And the ones that did made a scalp. Now we have another high. So second leg up, strong enough for two legs. We got the second leg. So bears will start selling. And there you go. Now we have two legs down. But, tight trading range. It's a dangerous, not a great area to buy or sell right here. And look what happened. Strong bear bar closing on its low. Another strong bear bar. You have a bottom. And this will entice traders to want to buy. Traders don't want to buy that. They see this and say, dang, I wasn't expecting that. Sorry, my voice is getting a little hoarse. Same thing with here. Traders buying this low, they say, darn, I wasn't expecting this bar. I'm going to get out. And I may use any rally I can to sell out with a small profit or small loss. Same thing here. Bulls, it's a compounding effect. Bulls buying here, they get out quickly, add to the selling pressure. You have some bulls wanting to buy the new low. However, when they see this and this, they pull their orders to buy. The traders that were filled just sell out quickly and take a small loss. You have bears who are saying, darn, I didn't sell up here because of the bad stop entries. I got to get short. So they'll just start selling small pieces. They're hoping they can sell a pullback, but they don't want to miss a possible collapse down to these lows. We have two obvious targets. We broke below a wedge. We have a double top. They're all in the same place. So we may get down here. So very dangerous. I would not. This is a surprise. Probably more down. And we're just collapsing. So again, this is why it's not a great, you hear Al say it all the time. 90% of the time you can make money depending on how you manage the trade, and that's totally true. Because a smart trader, well, let me say it this way: a trader that sees this and they buy, if they don't get out, they've got to have a stop down here because we may just melt down here all the way down. All the way down. And we did. So I wouldn't be buying. Very tight channel. It's way too tight to buy. You can maybe buy these lows for a scalp. If you're aware, you may just say, hey, we're probably going to reach these lows, so I'm just going to start buying down here, and I'll buy a little more lower. which is what traders are doing, but they're using these bars to take profits. They're testing the market. Traders want to see, can bulls make money down here? And they can, and look what happened. But we have a breakout gap. So we have a possible measuring gap. We did not close the gap, and you got to wonder, hey, we have a high, maybe this double top. This may be strong enough though for a second leg up, strong enough for a second leg down. However, in this case, you did get a second leg, but it's just more of consecutive sell climaxes here, here, and here. So it is 3 pushes. It's also a strong breakout below a first leg pullback, second leg. So climactic, exhaustion. So if I'd definitely get out of longs below the bar, although you probably will get a second leg up. And there's your second leg, but it was rather deep. Starting to go sideways, trying to form a bottom, but the bulls just cannot get above the moving average. They're failing to close this gap. We have a low 2, you can call it a triangle. A low 3, doesn't really matter. Probably will be the final flag. So if we break below and go a little lower, we probably will turn up. I think Cal mentioned, we had the March 26th gap over here. The high, I think it was, I'm forgetful where it was. Oh, it was right here. We had the high from the 21st. We were testing back into that. And then today we closed this gap. We had a big gap on the 29th of March, the 1st of April. Very big, so obvious. Probably will close it at some point, which we did. And by the way, same thing over here. We're rallying. Very difficult for bears to make money. If bears sell above highs, make money. They sell above highs, make money. Sell above highs, make money. They, even here, very strong, but still made money. So when bears start making money above highs, here, 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 and here, and here, even breakout up here, still made money above a high. Breakout here, made money. When traders do that, it makes it easier for, at some point, less and less bulls will buy new highs and will take profits, anticipating a sell-off. And then, of course, over here, bulls even make money on stop entries. So that's kind of the evolution of the channel. So let me go back to where I was. And other than that, probably a final flag, strong enough breakout, probably a second leg. We got the second leg. Then we had this really, really big bull bar. And the problem with the bars, we still it's the price. So you get a second leg. The odds favor a second leg. But you may have a very deep pullback. You have bears that will sell this high, scale in, which is what this bar is doing. We got the second leg, strong, and had a new low. So again, maybe a dominant feature, and you get 3 pushes, 1, 2, 3. So that's the problem with trading range environment, is it's never all that clear. So better to just buy low and sell high and scalp. You have, here's a low too. So some traders, they'll say, gosh, that's too strong to sell. I don't want to sell. I'll wait for a second leg. Kind of an obvious buy. Bulls will buy the low, scale and scalp out. But then they have a second entry short, especially a micro double top, closing on its low. Some traders will not. Most traders should not buy this low or this low. May reach a new low. And we did. Best looking bear bar for quite a while. Probably exhaustion, which it was. And then at some point, bulls are just going to buy at the moving average. They're not going to sell it. So try to get to the moving average, they sold. Try to get to the moving average, they sold. Very strong bar. Late in the day, reversing all these. Third push down. It's consecutive bottoms. 1, 2, 3, bear breakout. 1, 2, 3. So it's higher probability. We have an obvious gap here that I've talked about. And you have to think, okay, it's kind of bizarre, but it's an obvious gap, therefore it's a magnet. And even at the low of the day, we may get back to it. One of the things I want to mention about here So take a minute, think about this. 2 bars, sell off. And then here, 2 bars, sell off is, Al made the argument today, and I completely agree with it, that a lot of, he called it, the bears are trying to screw the bulls. And what better way than to, the bears want to sell at as high a price as possible. So the way they do that is they just start buying the open. And they try to entice as many traders as they can into buying. And then they dump out of their position and sell off. Now, some people people call it pump and dump and penny stocks. I think all that's kind of dumb, because the reality is the computers do not want to sell. Everybody wants to sell a pullback. Big gap down, they know trading range, bear trend, one of the two, less likely bull trend. Therefore, they know that on the open, they want to immediately disappoint the bulls. And the best way they can disappoint the bulls is to have them fail right on the open. So they're trying to get a trend from the open. The bulls want this on the open. They let them get a bar, let them get a smaller bar, and then just wipe them out. And then it makes a bear trend or a trading range for the rest of the day. Buy the close, but extremely big risk. So, at some point, buy the close, buy the close, buy the close, buy the close, but it becomes risky at some point and make it a sharp sell-off or a deep pullback, and you only have a few bars left in the day. I'm getting a little pressed for time, so I'll try and be quick. Trading range, 2 legs up. So, for always in on this day, sell the close. Bulls get out, but they have to get shorted. Bears get out, aggressive bulls buy, but they have to get short again. Probably best for bulls to get out above this bar, although it's not great. It's trading range. But if they do, they have to maybe get short again here. And then, maybe they get out of longs, out of shorts above here. And aggressive bulls buy, 2 legs up. They got to sell below. Bear bar closing when it's low, never when always in short. So they sell. Probably bulls get out, but they got to sell again. Bulls get out, but they got to sell again. And bulls buy. I think that's kind of complicated and hard for a lot of traders. So, it's really a limit order market for most of the day. Besides here, there's few instances of sell the close here. It's just really difficult. Traders are using strong rallies to sell, and they're selling above bars. Bad stop entries for the bears. Here's a great looking stop entry. It's a gap bar, but it's a micro channel. It's following 3 consecutive big bull bars. Anyways, here, bad sell on the open. Probably buyers below somewhere, especially after this rally. Strong breakout above, but probably sellers above this bar. And probably sellers above here, although we may go all the way up to here before we get down here. So traders will sell, scale in, scalp out. Some bulls will buy this close, but not really all that great. You can argue sellers below, but strong enough breakout, surprise for probably a second leg up. Here we have a surprise second leg up. 3 pushes up on the wedge, but tight trading range. Again, not all that strong. It's okay to get out of longs below, but everybody's scalping. So, it's not a great swing trading market, but I'd probably get out of longs below the bar. And, again, some bulls will buy, but not a great buy. It's trading range. It is always in long, but I believe there are sellers up here, so I'm more interested in selling with limit orders, at these closes above, and for that reason. So, again, I still think this gap's going to close. I think we're going to get back to the open of the day. This is just a mess for traders trying to swing trade. Here, double bottom, but it's a surprise. We had a surprise second leg up, bear breakout, surprise, odds favor second leg down, surprise bar up. So odds favor maybe 2 small legs up before we get the second leg down, and we have a second leg. Well, there you have it. Trapped a lot of traders. So we had a bear bar, a very small second leg, More traders interested in just getting out. And the one problem here, by the way, is it's a double bottom. So we have a low, rally, another low. Bulls want the breakout, measure move up, or the breakout from here. So strong bar, but big risk. Let's see what the follow through looks like. It's a doji, but it is follow through, so odds favor a small second leg. And you can see, so bulls bought, scalped out. They buy again, scalped out. So it's kind of a wedge. One push, pull back, two push, pull back, three pushes. Traders don't have to get out below, but I do think we will get a deeper pullback than traders want. We have an obvious gap right here. So probably will close the gap, but we may have to have a second leg up before we do close it. So sellers above, doji. Trying to close the gap, boom, close the gap. Even close this gap. Why? Because that's what trading ranges do. Two legs up, and we sell off. So very strong breakout, but bottom of a trading range. It's been a trading range all day, so you have to think we'll probably fall below the bar 18 bar, which is 10 o'clock. Here, if you're selling, stop probably all the way up here. Probably need to sell higher. So if you need to scale in, it's not really a great sell. Strong breakout bar, odds favor a second leg up. However, you also favor a second leg down from here. So as I've said many times today, or recently, you may get a breakout, a small two-legged pullback, and then a sell-off for the surprise second leg down. Just as you may get a strong breakout, we have a breakout bar here, you may get a second leg before you get the sell-off. Pause, second leg up, but traders scalped it because they knew it's minor. So bulls buy the close, and they'll buy a small pullback. They didn't get to, they scalped out for a few points. Traders sell the close, two legs up. They expect the price to get to here, maybe fall below the low, probably fall below bar 18, and they're scalping out. Bulls saw it's a bad place to buy down here, and this also is arguably a reasonable sell here. We're retesting it, and bulls buy. But again, it's a weak buy. Buy the close. Kind of dangerous to be selling right here. I don't think we'll get above here, but we may test all the way back up to here. So we're forming gaps, becoming difficult to sell. So probably buy the close for at least a little more up, and buy the close here. We hadn't had a bear bar in a while, probably more up, and boom. So that's all the time I have. Trading range for the rest of the day. Bulls gave up, sharp sell off. Thanks for watching.